Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly whirlwind through all the latest and greatest happenings in the residential lending industry. Each week, I am thrilled to be joined by one of our lender members as my co-host. And this week, TMC board member, one of our longest standing members, all around good guy, always dressed to the part, CEO and founder, U.S. Mortgage Corp., Stephen A. Milner. Stephen A., thanks again for joining me in the co-host seat.
Thank you, Rich. Thank you for the great introduction. You're the best. I really appreciate you.
Really interested to get your perspective on all the things happening right now in the industry. And let's start with Fannie Mae reported earnings yesterday.
Yeah.
And man, the mortgage meltdown and the bailout seems like decades ago. Times are good at Fannie Mae. 7.2 billion with the B in profit just in the second quarter. That's off the heels of $5 billion in profit in the first quarter, at 12.2 billion in profit. Year to date, forbearance related delinquencies down next to nothing, under 2% now. It's been falling precipitously. Their net worth, I think, is up over 37 billion now. It was like 14 billion 18 months ago. So much has changed with the GSEs just in a short period of time. Obviously, very profitable pandemic for them. The change in presidential administrations, we're working towards moving them out of conservatorship. Now it looks like, especially with these profits, that's a tough spigot of revenue for the government to shut off at this point, right?
Yeah. Well, I think refinances are what are they up about 65%? I think is the latest number, and I think and that was in the second quarter, and I think it was at about 243 billion, something like that. So people are still refinancing. We're still doing a lot of refinances, and I think today, I looked lately, the 10-year was at 117. I think the last time we spoke, it was, I don't know, 160, 170, something like that, right? So people are still looking to refinance, and with the compressed inventory, people are doing a lot of renovation loans. They're taking equity out to do home improvements, or they're doing the 203K or the home style, and that's certainly contributing to the bottom line for Fannie Mae. But certainly, it's great to hear that the GSEs are going to be here for a long, long time to support the industry.
Yeah, we've talked about it on this show. I wouldn't classify myself as like a big government utility guy, but for right now, what's going on in the mortgage industry, having them under the government thumb as a backstop, to me, is a good thing. And, it's provided a lot of stability and liquidity into the mortgage marketplace. And yeah, like you said, I can't see them going anywhere anytime soon. Now, we saw when the Obama administration was in office,
Right.
it loosely talked about privatizing the GSEs, but it never made any momentum. The GSEs were profitable then as well. But now it's really a different ball of wax, because not only are the GSEs as profitable as ever and huge revenue centers for the US government, but their ability to play a part in what this administration has talked about with regards to housing, first-time home ownership, lost in the big profit numbers yesterday. I think Fannie reported that, the astronomical amount of loans that they bought in Q2, like 41% or something, were first-time home buyers. That seems like a crazy high number to me.
Yeah.
That's what they're there for, right?
Yeah. I mean, listen, when, it's the fulfillment of the American dream of home ownership is not just a cliche. It is the reality of life in America. And certainly, as the Independent Mortgage Banker Network, the IMB network, certainly provides the path to home ownership. So do the community banks and the depositories, but the IMBs, I think, really do a tremendous job of providing home ownership and delivering loans to Fannie and Freddie. And again, like I said last time, don't forget, Fannie was started in, I think, 1938 and Freddie in 1970. And they were mainly established by Treasury to ensure that there was an opportunity for financing for home ownership. And we're doing a great job with that. And I personally think it's going to continue this year through 2022. And if inventory should increase, God bless America.
And I want a little deeper in the show. I want to get into your thoughts on how the rest of 2021 will play out. We talked about it last week on this show that it could approach last year's numbers, which is really staggering. But keeping on the GSE issue just for a moment here, on the flip side of the GSE issue, I think it was just last night, the official infrastructure bill, it's like a 2,700 page document. I linked it on my LinkedIn feed if everybody's really desperately bored and wants to read it. But the important part about that document is officially and formally in there is what we've heard murmured, that part of the funding of the infrastructure bill is an extension till 2032 of the 10 basis point guarantee fee increase that was originally implemented in 2011 to help fund a payroll tax cut.
Right.
Was set to expire in September. And but it looks like, and hopefully, I know the MBA has been all over this issue. See if they can have any impact and momentum in getting this removed out of there as part of the funding for this, because not like the adverse market fee, which is 50 basis points just on refinances, a 10 basis point guarantee fee increase, and just because they're extending it, it's still an increase. On the average loan amount in America, it's an extra $8,000 in interest for every person that buys a home in America going forward or refinances one. A really big tax on American homeowners. And the debate on general funding for the infrastructure bill and then the mortgage industry's piece of that, it's going to be very interesting to watch. Your thoughts on the matter?
Well, again, it's a sales tax, the way I look at it. And the industry should not be taxed. It's as simple as that. And as you know, I'm very involved with the Mortgage Bankers Association. I'm on the Independent Mortgage Bankers Executive Council, and we're doing all we can to defer that or delay it or to cancel it. And there's also word at times that they're thinking about, those rumors, I should say, that they may increase it. So we certainly don't want that, and I don't think it's beneficial to the dream of home ownership and what we're trying to do throughout the country. So I do believe that we have to curtail that or eliminate it, and I think we'll be successful, to be quite frank. Or we'll have to wait and see. But certainly, to me, it's just a sales tax, and homeowners should not have to pay for that.
Yeah, something certainly to keep an eye on. It'll be in the news for sure, just as the infrastructure bill will be. Will be something very interesting to follow along. And I think part of it is, though, I think what the government is not saying, because they really can't say it, but my sense is what they feel is, listen, the Federal Reserve is buying the hell out of the long end of the bond market and the mortgage-backed security market. It's driving interest rates low. So you giveth with one hand, you taketh with the other. It's kind of like a shell game almost. But the imperfect part of that analysis is the Federal Reserve's policy is day to day. If something could change today or tomorrow, that could change the Fed's bond buying strategy as to where this increase in G fees would be for another 11 years.
Yeah, and I don't think they're going to taper their asset purchases in the short term. And if they continue to purchase assets as they have been, and as they very proactively did starting in March of last year, right? That they'll continue that. Chairman Powell has, I think he said something to the effect that there's still a lot of ground to cover in that regard, and I think that they're going to continue with asset purchases that'll create the demand, forcing prices up and yields down, right? So I think that'll stay that way for a while, and I think that's why we recently went down to where we are now in the 10-year, 117. So I think that'll result in more refinances, more stimulus to the mortgage banking business, if you will, and to the general economy. So he's got a tough. It's not easy for him and the Federal Reserve to balance that, but I think that we may see a little less asset purchases as the economy recovers, if you will, and as employment increases, but we'll have to wait and see. But I think we'll be in good shape through the end of 2021, at least through Q1 of 22, quite frankly.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative this week, joined by U.S. Mortgage Corp founder and CEO Stephen A. Milner. And Stephen A., you talked about it, like what it's been a great year for the industry. Again, over $4 trillion in originations, a record last year. A lot of the economists have come out and upped their projections for this year. Everybody, almost all the economists' projections were like 3.2 trillion, down about a quarter for this year. Already up now to between 3.8 and 3.95, depending on who you look at. And it just goes to show in this industry, it's so hard to predict the future. I think everybody kind of felt like, okay, 21 is going to be a good year. Refi is going to go way down. Purchase is just going to slowly ramp up because all this pent up pandemic. What we didn't anticipate is home values get out of hand, really skyrocket in the spring, pushes a lot of buyers to the sideline, pushes a lot of sellers that can't afford that next step up home because of the increase on higher priced luxury homes to the sideline. Right. On the flip side, Delta variant of COVID pushes rates low, Fed much more aggressive in buying, the mortgage-backed security market, refis way stronger than anybody would have thought, right? Through 7 months. Yeah. Purchases probably not. You mentioned renovation loans. How are you looking at the last 5 months of 21 from just a business owner standpoint?
Well, surprisingly, we're pretty much on track with what we did last year personally at U.S. Mortgage, and I'm kind of excited that the industry expects. I think the expectation is 4.1 trillion is the last number I heard. And listen, I think as a mortgage banker, there's still opportunity for loan officers to pursue their closed loan pipelines that they had before April of last year. And I know we do that here at U.S. Mortgage. We try to really encourage our loan officers to pursue that business. And yet we're still primarily a purchase money shop. But I just think that we're going to continue along this path, and we're going to, I think most companies will have almost the same amount of volume this year as they had last year. And that's of course subject to rates staying where they are, which I think they will. And as far as housing demand, yeah, you'll have the housing demand continuing for the next, as I said, through 2022, I believe. I think values may come down a bit, and that'll just inspire more buyers to stop paying rent, if you will, and to pursue that fulfillment of the American dream of home ownership. And I think they'll continue to do that. And values throughout the country, as we're licensed in every state, so we see the same kinds of things all over the place. Values are just through the roof. 10, 20, 30 offers on every single property above listing price. It's kind of crazy, but
it's going to be really interesting to see how it plays out anecdotally and through some statistics we're now seeing starting to come out. It just feels like there's this huge inventory of buyers out there, like that just got fatigued by the home sale appreciation madness, are still very active, willing buyers, renting, like you mentioned, or wanting to move into a bigger home. And it's really a value thing. I mean, I think at some point, as long as values don't keep going up crazy, I think a lot of these wannabe buyers are just going to bite the bullet and say, hey, I thought values were going to come down from where they got inflated to in the spring. Could lead to a strong, if values just stabilize here into the fall and the winter, I think you could see a lot of people, especially young people, get sick of waiting and want to get into that new house by Christmas.
Yeah.
A big fall for purchases.
Yeah, I think you're right, 100%, and they're just going to have to be a little patient. I think values will start. We may see them come down in Q2, Q3 of 22, but I think we'll be strong through this year and next year, quite frankly.
You mentioned, Stephen A., your company on track to do just about the same amount of business as you did in 2020, which is phenomenal. Continue. You guys always have been really known as a purchase money shop. It has been another strong refi year. How have margins held up? I mean, last year, obviously, these margins were unsustainable and, unlike anything we've seen in a long, long time in this industry. But it seems like from our members I talked to that margins are obviously down from last year, but they've held in there probably better than most thought as we get into the summer here of 21.
Yeah, I mean, they're not as high as they were last year, but I'm very thankful, quite frankly, personally, that margins are at what they are right now. We're still making money, still paying the bills, still very, very, very profitable. And we continue to build our net worth and our equity in the company. And it's been a great 2, 3 years for us. So personally, and I think it's going to continue. It's all about income and expense, and margins are very, very important to keep track, to keep a watchful eye on. Yet you still have to provide a competitive interest rate for the consumer and for the loan officer, right? And we're very focused on that. But I think we're okay. I think we may never see the kind of margin spreads we had last year. Let's face it. But I think we're doing. I think the industry will continue to see very reasonable margins going forward. So it's a little bit less than last year, but nothing significant in my opinion.
This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative here with U.S. Mortgage Corp. Founder and CEO Stephen A. Milner. Stephen, we, as you know, did a survey of key decision-making leaders from our, I think now 241 lender member companies across America, just taking their temperature on, all the issues most pertinent to us in the mortgage industry.
Right.
Number one issue that came back was retention of existing employees. Just thinking about the competitive climate. Where are you guys at? Work from home versus come back to the office, and the whole culture with more remote employees. Like Loan Depot, I was reading their earnings release this morning, and like one of the things they mentioned, I've seen some of the other big public IMBs mention is just their view that there's going to be a lot of consolidation in the mortgage industry. You guys are certainly not a small company. How you look at just, I guess the competitive climate in general going forward in terms of recruiting and retention of individual people across America, and then just on a company-wide basis, the competitive climate and the M&A climate potentially going forward.
Well, interesting. There's a lot of points that you made there, Rich, but a company's culture is extremely important, whether they work, whether or not the employees are working in the office or at home. And our core values, which are actually directly behind me, it's our employees are our biggest asset, and we are very much focused on recruitment, but we are more focused on retention. And I think it's very important to, now that COVID has subsided, to travel to your branches, to explore what the challenges and opportunities and frustrations that employees have, to really drill down on that, take an interest in their family lives and their personal lives. And I've always said, and I think I've shared with you, that if a person is going to come for money, then they're going to leave for money. And I'm not ashamed to say that. That's not what we're about. We're going on our 28th year, and I think companies have to realize that longevity is very important in a corporate environment, and our leaders have to do what we can to retain our people. But it's not just about closing loans; it's about understanding where they have been and where they are going, and understanding their lives and their families and the challenges that they're going through. So it's a lot that goes into the retention factor. And I'm very proud of our leaders here at U.S. Mortgage, but I think overall, every company should be focused on maintaining a personal relationship with their employees as much as they can. Now, that said, there are challenges with people working remotely. We understand that. That means you have to work even more diligently, more deliberately, if you will, to really understand what they're doing, whether it's sending birthday cards, whether it's sending anniversary cards, anything you can do to make them feel that this is their place to be. And personally, my goal has always been to serve as an employer for life. And I get very emotional when somebody leaves. I take it personally. I simply ask myself, what could I have done better? What could my leader have done better to preserve that person, that employee? And it seems to work for us, and that's the kind of message I try to exude. But I think that consolidation will occur. We've been seeing it. Like you mentioned, there's been a lot of M&A activity. Some people are looking to take their chips off the table, which I understand. And they want to cash out. Personally, I don't have any interest in that. Especially with my son Scott A. Milner, who joined the company 10 years ago, and he's going to carry on the legacy of U.S. Mortgage for another 50 years. Except he can't keep up with me, though. That's one of the problems.
Big shoes to fill, right? Exactly. Yeah.
But I can go on and on about that topic. But longevity is very important to employees. They need to know that they're going to work 10 or 12 hours in a company that the company cares about them.
Very prophetic and so important, just, being in the fortunate spot to get to talk to our members each day and each week. There's all different kinds. There's, companies that started 3-4 years ago that, just growing like a weed because it was good timing. Community banks that have been around for 100 years, but maybe their philosophy towards mortgage lending has changed. But I just really feel like companies like U.S. Mortgage Corp, you guys always have been so culture rich. You've said it to me many times before. You just said it again. There's a real extreme and consistent focus on employee retention, and obviously looking to grow the company, wisely when you can, but never to take your eye off the ball of what you have. And then, like you said, the succession plan, like your employees know U.S. Mortgage Corp is going nowhere ever because you've been doing it since 1994. And yeah, you're a very capable son that already is playing a huge role.
Yeah, very much so.
Moving on, FICO score. A lot of talk in the news just about, is FICO kind of losing its hold on the mortgage market? Been a lot of talk about, alternative credit score models. Not too much of that has worked its way into the mainstream mortgage marketplace, other than Fannie and Freddie really maintaining the consistent stance that they're open to it and that they do believe in it. But just as America evolves, the traditional FICO score and how it's tabulated, maybe not the most accurate predictor of, ability and likelihood to repay. I haven't been in the industry just a long time. Your thoughts on FICO, alternative credit models, and what direction this may go in as we move into the future here?
Yeah. Well, I like the three models, I think that's going to stay for a while, and everything in mortgage banking is always about ability and willingness to repay. So there's many different ways that you can measure the willingness. Of course, the credit report and the FICO scores are one way, but I don't personally think that's going to go away. I'd rather see 3 scores than 1 score. So I think the 3 FICO scores will stay for a while, and I think that we need that to measure. The 3 FICO scores just contribute to the willingness of a borrower to repay, but there's other factors. Don't get me wrong. I can tell you for one thing, I'm very much focused on payment shock, which can always be related to the willingness, equated, I should say, to the willingness of a borrower to repay their loan. So when I'm looking at a file, because I underwrite, I have my D underwriting as well. But so I've seen more files than most people, I would think, but I am always personally very focused when I'm looking at payment shock, and savings ability. That all contributes to willingness to repay, not just the credit scores. So if someone is renting, for $1,000 a month and they're going to $3,000 or $4,000 a month, well, that could be an issue, right? I mean, and if they have not demonstrated any savings ability, then I think the willingness to repay could be impacted. That's just my philosophy on that as an underwriter.
This is the last week in Mortgage Today. I've got about 5 minutes left with U.S. Mortgage Corp founder and CEO Stephen A. Milner. Stephen A., emerging tech, a perpetually issue of interest in the mortgage industry. I remember, you and your son leading sessions on assessing emerging tech options at our conferences going back 5-6 years ago. U.S. Mortgage Corp always been very proactive and, task force of key leaders to always keep a very close ear to the ground as to the emerging tech climate in our industry. I'd say in general, like, the way most of our members feel is that, and I think it was accentuated last year because it was so busy. And the mortgage manufacturing process was still so human that, just comments from lenders as we were going through the summer and fall and the dog days of a very busy record 2020. The tech, it's here, but not in like life-changing, efficiency saving ways. Your thoughts on just the current state of emerging tech in the mortgage industry and your experience with some of those items I just mentioned this last year.
Yeah, very good point, Rich. I just think that technology is just the emerging technology is really a very important component of a successful mortgage company at this stage in the game. Personally, we've spent a lot of time, effort, energy, and resources on expanding our business intelligence team and our technology team. We spent a lot of money expanding that division. I really believe that loan officers need it, our employees need it, and we have. I think it's important for a company to have just a culture of information, for lack of a better description. You have to have that culture, and and I've always been a folder guy. Believe me, everything I've always done my whole life has been, and I'm doing this 42 years now, but now I've really become very proactive about using data that our business intelligence team has been provided. Personally, I don't think just to get a little granular, I think one of the goals should be where a loan officer never has to call their processor. They should be able to look at a data report, know exactly what's going on, and those reports have to be current and correct. And data and technology can provide that, provided that the inputs are done accurately and frequently. And I think that'll just lead to efficiencies. And there's so many sources for those technology efficiencies out there that, of course, the Mortgage Collaborative provides a lot of access to different organizations and vendors, if you will, that provide alternatives to a lot of the, to implementing technology. It's challenging, believe me, but I think it's important for a company to expand their resources and really focus on that going forward. But I think that's the way to go. And if you're hearing that from me, who's been, again, a folder guy my whole life, and I really embraced it, and as you know, I still originate a lot of loans, so it really helps me, monitor what's going on, and on in the pipeline, and then that's what it's all about at the end of the day, from origination all the way through closing. So I'm very much a proponent of that, and TMC has really done a great job helping their members explore some of those vendor options, if you will. And there's so many out there. It's just a matter of integration, right, with your LOS and every other vendor that you implement in the company. That's the biggest challenge, integrating everything. But I think it's important that we do it.
Stephen A., thank you once again for joining me this week. Really appreciate and enjoy your perspective on the industry. Appreciate your membership and just your general high level of engagement within the network. And thank you for joining me this week.
46 days. You know what that is?
Terranea. Am I right?
What's that?
Our conference?
Yes, sir. 46 days, bud.
I can't wait.
I can't wait. I'm so excited, and I can't wait to see everyone. It's been a little bit of a withdrawal not being able to interact with all the members from the TMC. And again, I'd like to say one thing, Rich, you're doing a great job. The organization is doing a great job. And anyone who happens to be on this call, perhaps, that's not a member, please join. It's an outstanding organization.
Thank you. That means a lot coming from you. And yeah, we've been kind of dubbing it family reunion because that is really what it feels like. Our members are a family. We've got a lot of great new members that are going to be there for their first time.
Oh, great.
to meet the members. So, and a registration, we've already got more registered attendees than we've ever had at a TMC conference ever, with 7 weeks left. So,
Awesome. Very good.
yeah, so it'll be a very
Very excited, yeah.
time.
The venue looks amazing, so it's gonna be pretty cool.
I was out there doing a little quality control a couple months ago, and yeah, I can attest that it is amazing. So, but Stephen A., thank you
You're the
again,
best.
and to all of our attendees, thank you very much for taking 30 minutes of your day out with us every Tuesday at 2 p.m. Eastern for the last week in mortgage today. And as always, we'll be uploading this video to our YouTube page and releasing it also as a podcast on Apple and Spotify and all the other podcast networks. So until next week, have a
Beautiful.
good week, everyone. Take care.
Thank you all.